Most people enter the world of crypto through a door labeled hype. They see the headlines, the overnight success stories, and they rush in, driven by the fear of missing out. But true wealth in this space isn't a fantasy. It's a calculated risk framework. It's built on a foundation of asymmetric bets, patience, and rigorous risk management. The typical retail investor chases green candles, buying when the euphoria is highest, only to be caught when the trend reverses. Contrast that with a strategic builder. They don't react, they plan. They focus on three core variables: deep research, risk mitigation, and the power of time. To win, you must first understand the rhythm of the market. Every cycle moves through four distinct phases that repeat over and over. First is accumulation. This is where smart money buys when blood is in the streets and interest is at its lowest. It's quiet, boring, and where the most value is found. Then comes the markup. Prices start to climb, the media begins to notice, and the masses begin their entry. This is the hype phase. At the peak, we see distribution. The early entrants sell their positions to the latecomers who are buying based on emotion, not logic. Finally, the markdown. Prices collapse as liquidity dries up, leaving the late entrants underwater and setting the stage for the next accumulation. Beyond cycles, you must understand Bitcoin dominance. When Bitcoin leads, the market follows. It's the gravity of the entire ecosystem. Liquidity flows like water. It usually hits Bitcoin first, then Ethereum, then moves down into smaller, riskier assets. Following this flow is more important than following any influencer. Look at history. The rise of Bitcoin and Ethereum wasn't a straight line. It was a series of brutal 80% drawdowns that shook out everyone without conviction. Those who achieved outsized returns didn't just get lucky. They had the volatility tolerance to hold through the dark years when everyone else said it was over. Meanwhile, the majority of late entrants bought the tops during euphoric phases, providing the exit liquidity for those who entered during accumulation. So how do you play this? First, favor dollar-cost averaging over emotional lump sums. By buying at set intervals, you neutralize the fear of a local top. Second, master position sizing. Never put so much into a single trade that its failure could destroy your entire portfolio. Survivability is the first rule. Third, take profits on the way up. It's better to sell too early in a profit than to hold all the way back down to zero. Realize your gains to fund your future. You also need to recognize narrative waves. Crypto moves in trends. Understanding which wave is building and which is crashing is essential. From the decentralized finance boom of 2020 to the NFT craze of 2021, these narratives create massive opportunities for those who arrive before the crowd. And today, we see the rise of AI tokens and infrastructure. The key is to identify the utility before the hype makes it overpriced. A simple capital split might look like this: 60% in blue chips like Bitcoin and ETH, 30% in established mid-caps, and only 10% in high-risk moonshots. Most of the rich in crypto didn't trade their way there. They found quality assets and held them through brutal volatility. They let time do the heavy lifting. Constant trading is a trap. It leads to emotional exhaustion, high fees, and almost always results in underperforming a simple buy and hold strategy. Now for the warnings. Leverage is the fastest way to lose everything. In a market this volatile, a 10% dip can wipe out your entire life savings in seconds. Meme coin gambling might look fun on social media, but for every winner, there are thousands of losers who bought into a project with zero utility and zero future. And never blindly trust centralized platforms. The collapse of giants like FTX is a stark reminder. If you don't own your keys, you don't own your crypto. Custody matters. At its core, success in crypto is about discipline. It's about doing the boring research while others are chasing the shiny new thing. It's about mastering your emotions. In the heat of a bull run or the depths of a bear market, your ability to remain analytical is your greatest asset. Don't invest out of desperation. If you're looking for a miracle to save you, you've already lost. Invest because you believe in the long-term shift of value. Crypto rewards the disciplined, the patient, and the prepared. It is not a lottery. It is a new frontier of finance for those who know how to navigate it. This is not financial advice. Always do your own research. The market is high risk and high volatility. Never invest more than you can afford to lose.